Hello, I'm Brett Carleton, coming to you from the offices of Heritage Wealth Management. I'm going to start out today by talking about the big economic news of this quarter, and that was the Federal Reserve here in the U.S. Announcing the change in their policy stance from one of tightening to one of easing by cutting interest rates or the federal funds rate by a half a percentage point. The reasons they're doing this is it appears that they've got inflation, I don't want to say under control, but to a level they're comfortable with. That, and we're beginning to see the economy slow a bit. But this is a huge change. If we think back to March of 2022, a little over 2.5 years ago, the Federal Reserve began to raise interest rates because inflation was running, I don't want to say out of control, but it actually peaked out at 9.1%, and the Federal Reserve stepped in, started raising interest rates, actually 11 times in about 2 years, which is the fastest they've ever raised rates in the history of the Fed. But it appears to have worked. So at this point, with inflation within a range that they're comfortable with, now they're concerned about the economy, keeping the economy growing, and employment. We've had a bit of an uptick in unemployment, even though the employment numbers look okay. But what they want to do is start easing, and not with just this cut. They've talked about more cuts later this year, as well as cuts into next year. So as long as the data continues to reinforce that inflation is under control, we will see interest rates lower. And that's hugely positive from the standpoint of the economy, because by interest rates coming down, what that does is that encourages business investment, borrowing and investment. It encourages consumers, unfortunately, to borrow and to spend more. But those are both positive for the economy going forward. And what the Fed is hoping for is that they can achieve this soft landing, which, if you remember, one of the most common causes of recessions is the Federal Reserve raising interest rates too far and holding them high too long, and having that hard landing where we go into recession. And there's many reasons to believe right now, if we look at what's happening, that they may actually accomplish this, because corporate earnings continue to come in strong. The employment numbers, yes, we've had a tick up in unemployment, but employment numbers have fully recovered from the pandemic and all the layoffs that occurred during the pandemic. And employment has actually grown a bit. So they want to keep employment growing, because, again, that's a huge economic indicator as we go forward. But the final thing is consumer spending. Consumers have continued to spend. It appears that most of the COVID surplus, the money that was handed out to Americans that we accumulated during COVID, has been spent down. So now it's people working and having the ability to borrow, and that will really be positive for the economy as we go forward. The other big factor in this is as the Fed lowers interest rates, we've seen mortgage rates come down. They're still high if we look back over the last 15 or so years, but we're getting into a more normal interest rate for mortgages if we look back over history. So that could be a real positive factor as we go forward, and maybe getting more activity in the real estate market. Because if you remember, as people buy a home, they buy new furniture, appliances, window coverings, and actually a new automobile. So getting people buying homes again is very positive. There's a couple things always, because there's always a couple things to be concerned about. But the one thing that's taking up much of the news right now is the presidential election. And typically presidential election years are just a lot of noise. Historically, they've had elevated volatility, but ultimately it tends to be just a lot of noise. I would say the bigger concern out there would be war in the Middle East and war in Europe. And we've been very fortunate, and it's been very helpful inflation, that oil prices have actually come down significantly this year, with war in the Middle East and war and actually in Europe, including Russia, which is one of the biggest oil and natural gas exporters. So we're really going to have to watch and see what happens there. Do these skirmishes spread, or do they get some type of resolution this year? So that's actually something we want to watch. But the thing that we've been most, excited about here is the breadth of this rally. We've all heard talk of the Magnificent Seven stocks, the NVIDIAs and Apples and Amazons of the world, but the rally has really spread to encompass international stocks, smaller companies, financials, and others. And that's a real positive from our perspective, because it allows us to be able to do some rebalancing within portfolios, hopefully even taking back risk a bit because we're buying companies that are not so expensive. The other big thing that's come out of this is bonds. If you remember back to 2022, that was just a terrible year for bonds. With the Fed raising interest rates like they did, bonds fell that year about 14 to 15%. Well, now corporate bonds are yielding 5.5, 6+ percentage points, so we're getting a very nice dividend from bonds. But also, as interest rates trend downward, the value of our bonds will come back. So we'll regain a lot of that value that we lost over 2022. So it's an exciting time as we look at bonds as a more stable piece of our portfolio that we would expect to bring above average returns if we're in an interest rate environment where rates are going down. So a lot to watch right now. There's a lot of noise out there, but the goal is we have to stay focused on our plan. We have to stay invested. So that's enough for today. Any comments or thoughts or questions you have, please share them with us. We always love to hear from you. Look forward to talking to you soon.